Hello everyone to our video tutorial series on the basic concepts of trading. This video will be addressing the topic of leverage. We will be discussing about what is leverage and how it affects your trade positions. So to start with, what is leverage? Leverage is a multiplier which allows you to open trade positions larger than the amount that is available as your initial deposit. So for instance, if you open a trading account and deposit say $1,000 and select a leverage of 100:1 for your account, then 100 leverage allows you to open trade positions 100 times 1,000, which was your initial deposit amount. Secondly, leverage increases your return on your trade positions. Since by leveraging, you are increasing the size of your trade, therefore, the return will also increase. However, since risk and return go hand in hand, so though leverage provides higher return, it also increases your risk or exposure towards any hypothetical or potential losses which you could incur in case the trade goes against you. Let's consider an example of a leveraged position. Now, if you were to open an account with a deposit of say $5,000 and no leverage. Now let's say you wish to open a trade position of one standard lot of euro-dollar at the current rate of 1.30500. So using the margin requirement formula which we went through in our margin calculations video, we get that the margin requirement to open this one trade position on one standard lot would be contract size, which is 100,000, times lot size, which is one standard lot, times the price, which is 1.30500, the product of that divided by the leverage, which is 1 in this case. Therefore, the margin requirement comes out to be $130,500. So this is the margin amount which would be needed or which is required for you to set aside in order to open a trade position of one standard lot on euro-dollar. Of course, this much amount is not available since your deposit is only 5,000. Hence, you will not be able to open a trade position in this case. However, let's say you choose a leverage of 100:1 for this account. Now your margin requirement, using the same formula that we used before, becomes contract size times lot size times price, product divided by leverage, which comes out to be $1,305, which you can easily provide from your initial deposit of 5,000. Therefore, now you will be able to open that trade position of one standard lot of euro-dollar at the open price of 1.30500. So this way, leverage enables a trader to open positions which he otherwise would not be able to open, considering the initial deposit or the amount that he has put in forward as his deposit. Now, since the account leverage is 100 and your initial deposit is 5,000, and since leverage, as we stated, is a multiplier, so you can open positions up to a size of 500,000, which is 100 times your initial deposit amount, and only use a portion of this as margin requirement depending upon the trade positions that you have open. Now, few important things to remember about leverage is that leverage amplifies your exposure to both profit as well as loss. So though it increases the amount of return that you can get on your trades, it also increases your risk to losses in case the trade goes against you, which is why it is also known as a double-edged sword, since it can work both for you as well as against you. Therefore, it is mandatory that you select the leverage for your account carefully, keeping in mind your own risk appetite. This is all about leverage that we will be covering in this video. Thank you for taking the time out.